Good morning and welcome to the Brait webinar. My name is William Eatwell. As a sound check, please indicate in the comment section if you're able to hear me. To begin, the agenda for this webinar will be as follows: recommendation, nature of business, financial review, divisions, company guidance, and lastly, portfolio guidance. Let's move into the recommendation. We recommend an exposure of up to 5.32%. We feel that the share offers values at current levels, with the share price at a 37% discount to Brait's management estimation of fair value. We estimate that the current share price implies a further 18% decline in EBITDA, assuming stable exchange rates and stable valuation multiples, which seem pessimistic. Given the highly geared nature of the structures in which the investments are held, changes in earnings and valuation multiples of investments has a significant impact on its reported value. The share is currently trading at a 30% discount to our estimation of intrinsic value, primarily due to the high discount that we apply to peer spot multiples, given the unlisted and highly geared nature of its investments. The sensitivity of the group's investment to earnings changes was confirmed by management, reducing the value of New Look to zero until its recovery is established. Exchange rate volatility, especially the Great British Pound, given that the majority of assets are concentrated in the UK, is likely to have a material impact on investment returns, given the uncertainty related to the UK economic environment. The group's largest investment, Virgin Active, had its valuation increased by 8% in pound terms since 30 September 2016. The investment offers an annuity-type income stream and continues to de-gear due to strong cash flow. However, membership growth poses a challenge. Iceland Foods' valuation was written up by 9% in pound terms since 30 September 2016. This was primarily due to an increase in maintainable EBITDA, while the EBITDA multiple remained the same. Its online presence is outgrowing the market, whereby its online service distribution radius covers 84% of the UK population. The company has a good market share in the UK frozen food market of 15.3% and 2.1% of the UK grocery market. However, sustained like-for-like sales have been impacted by an intensely competitive UK retail climate. The Premier valuation was decreased by 3%, primarily due to a lower EBITDA multiple. However, EBITDA improved slightly from March 2017. The Premier business has a significant exposure to the informal market, which accounts for 70% of bread sales volumes, which due to a strong brand positioning and positioning in the staple food segment should provide some consistency in earnings. To move on to the nature of business. Brait is an investment company focused on driving sustainable long-term growth and value creation in its investment portfolio of sizable, unlisted businesses operating in the broad consumer sector. Brait's shares are listed on the Euro MTF market of the Luxembourg Stock Exchange and also on the JSE. To move on to the financial review. Brait reported a net asset value of R66.62, a decline of 10.1% compared to the net asset value of R74.14 at 30 June 2017. Net asset value was significantly affected by the valuation of New Look, which has been reduced to nil. Operating expenditure for the year amounted to R135 million, which represents 0.61% of average assets under management, which is well within management's target of 0.85% of average assets under management. The group's cash and cash equivalents total R3.3 billion, representing 9.7% of net asset value, which is within the target range of below 25% of net asset value. A cash translation gain of R212 million was recognized due to the positive effect of exchange rate movements. To move on to divisions. Virgin Active contributes 41% to Brait's total assets. Revenue grew by 5% on a constant currency basis to £421 million, where membership remained largely stable. Revenue in South Africa grew by 6%, where membership was down 1%, with 11 new clubs opened. Revenue in the UK grew by 2%, where membership was down 2%. Revenue in Italy was up 3%, where membership was 1% higher, while revenue in Asia Pacific was up 19%. Portfolio EBITDA grew 2% to £98.5 million in constant currency terms. Asia Pacific saw new club opening costs offsetting its revenue growth, resulting in EBITDA only growing 3%. UK saw EBITDA improve 14% following the head office restructure after disposals were made, while Italy reported a 15% climb in EBITDA following its growth in revenue and membership flowing through, while good cost control aided EBITDA growth. Portfolio EBITDA margin contracted by 70 basis points during the period to 23.4%. This was impacted by an 8% EBITDA decline in South Africa, where there is continued focus on sales and marketing investment in order to grow volumes. Double-digit EBITDA growth is anticipated for 2017, supported by currency tailwinds. Furthermore, the traction made in Italy should provide a boost to EBITDA, along with the recent volume growth in the UK should translate into higher revenue. The difficult consumer environment in South Africa is expected to continue, where there has been a focus on lower price points as well as trialing of different membership options, whilst a moderation in the rollout pipeline has been cited. To move on to Iceland Foods, total sales increased by 7.3% or 4.3% on a like-for-like basis to £1.3 billion. This was supported by the net 17 new stores opening in the period and aided by the net 21 new stores opening in full year 2017. Total sales were ahead of the market. Like-for-like sales saw a downturn on quarter 2 to 2.2% from 6.4% in quarter 1. EBITDA had grown by 5.2% to £60.9 million. EBITDA margin deteriorated marginally from 4.8% to 4.7%. Refits of traditional Iceland stores had commenced in October 2016, whereby 34 store refits were completed at 10 November 2017, which all achieved incremental like-for-like sales growth. The goal is to have 55 store refits by year-end, mainly in London and the South East, and the plan of opening 24 food warehouse stores per annum is continuing, whereby 11 new stores have been opened in the first half of the financial year and 6 additional stores thereafter. A significant improvement was made in working capital, achieving a positive year-to-date movement of £23.8 million due to favourable timing of supplier payments. Iceland purchased and redeemed a nominal total of £50 million of floating rate notes at a redemption price of 100% of the principal amount, plus accrued and unpaid interest. Assuming Iceland repays the remaining £79.5 million on the floating rate notes through internally generated cash, there should be no refinancing requirements until at least 2023. Going forward, tougher trading comparables are expected, as well as cannibalization from own new stores and greater competition in the market on value. Forecast net debt to remain approximately the same at £675 million as in full year 2017. Exceptional costs pertaining to getting the D-side depot operational, litigation expenses, and management restructuring is expected. To move on to Premier, net revenue was down 10%, largely due to the milling business, which accounts for 1/3 of Premier's net revenue. This was impacted by extreme maize commodity market pricing volatility. Bread and maize contributed 46% and 19% respectively to net revenue. Competitive promotional pricing put pressure on bread sales volumes. However, market share of 23% across all its bread brands was maintained. Maize revenue decreased by 22% as volumes fell 7% to the prior period due to consumers substituting into cheaper staples. This resulted in stocks of maize lasting longer than planned. In addition, maize margins fell 4% lower due to maize stock being sold at below budgeted margins. Revenue in Premier's wheat business fell 7%, whereby sales volumes decreased 4%. EBITDA margin eased to 8.3% from 9.9%. Going forward, management expects the milling business to outperform the comparable period for the remainder of the full year 2018. This is after the maize commodity price volatility has normalized in the second quarter of full year 2018. Moving on to New Look, from a sales perspective, UK sales decreased 6.1% to £463 million, while e-commerce sales declined 7.6% to £94.9 million, with third-party e-commerce partners increasing by 17% to £33.7 million, while international sales declined by 1.5%, which on a like-for-like basis is a decline of 7.9% to £86.3 million. This is on the back of challenging trading conditions in Europe, which offset year-on-year growth in China, in addition to favorable currency movements. Franchise sales improved by 7% to £16.9 million. The cost base for New Look increased 7%, or 1.6% after adjusting for foreign exchange and once-off annualized investment costs to £343.8 million. From an underlying profit perspective, UK retail went into negative territory with an underlying operating loss of £8.7 million from an underlying operating profit of £42.4 million in the prior period. International extended its underlying operating loss by 53% to £12.1 million, whilst e-commerce deteriorated 89% to an underlying operating profit of £1.4 million, whilst third-party e-commerce partners weakened to £6.8 million from £7.8 million, and franchise eased to £2.2 million from £3.8 million. Adjusted EBITDA was £24.2 million, a 72% decrease to the prior period. What was notable was performance had weakened further in the second quarter. There was a multitude of reasons for underperformance that was highlighted. Namely, the broader appeal of New Look shifted and became too young and edgy, with the range becoming overly fashionable, losing its value proposition. The e-commerce platform chased sales, impacting profitability. In addition, the company was slow to update to trends on the back of excessive product options, and increased complexity impacted the organization's flexibility. Stock was also not moved quickly enough, and compounding the issues was sustained difficult market conditions. A primary focus for management is an adequate cash and liquidity profile, which is in place. And following the interim results, New Look signed an agreement with its core operational bank to provide increased bilateral liquidity and operating facilities totaling £100 million on a fully committed basis, pari passu with the rotating credit facility. Committed rotating credit facility will amount to £100 million. To move on to company guidance, good momentum seen in Italy and a strong pipeline in Asia Pacific is expected to provide medium-term growth opportunities for Virgin Active. However, the South African market will be a challenge owing to the tough consumer market, which is set to continue. This has prompted management to slow down the rollout pipeline and to look at lower price points and trialing different membership options to grow volume. Iceland's recent refinancing should enable it to pursue its well-established long-term strategy for growth with the benefits of lower borrowing costs. New Look's second half of the year is expected to remain challenging, with management intent to focus on short-term stabilization of the business in order to maintain its liquidity profile. This is to be achieved through cost control. Factors that were largely self-inflicted that had affected interim results are expected to be addressed going forward, with the goal to recover its broad appeal after full year 2018, where managing cash and establishing a profit recovery are the most pressing issues in the short term. In addition to the improved planning cycle to reconnect with its heartland customer, there has been changes in senior management. It has been stressed that the business maintains a sufficient liquidity profile and operating facilities in order to implement their plan and provide time to recover. To move on to portfolio guidance, Brait has a JSE capped SWIX weighting of 0.32%. We feel that the share offers value at current levels, but would only recommend the share to speculative investors at this stage. Given the investment's low weighting in the benchmark and the high expected return, we recommend a portfolio exposure of up to 5.32%. In closing, please take note of our disclaimer. If you'd like to place a trade, please contact our trading desk. In addition, should you have any questions, please use the comments section now, and we'll reply to you via email. It seems no more questions are coming through. Thank you very much for joining. Goodbye.